Sometimes you get a bigger piece of the pie, and sometimes you get the short end of the stick. But when it comes to planning for families, it's critical to ensure everyone is treated fairly. Like it or not, that goes for money too. One of the biggest issues we see in our industry is poor estate planning, especially with illiquid assets. An illiquid asset is something that isn't easily divided. It could be a family business, a vacation home, or even a valuable collection like antiques, art, or coins. These assets are extremely valuable, both financially and emotionally. So it's important to create a plan that protects these assets while also promoting tax efficiency and family harmony. The solution is called estate equalization, and it could make a huge difference for your clients and their families. Let's look at how it works. Anyone who owns a valuable illiquid asset needs to consider how that asset is passed to the next generation. Look for 3 common situations in your client base. 1. Closely held business owners. 2. Owners of prized assets such as real estate or collections. And 3. Blended families. Business owners are a common candidate for estate equalization because the majority of their assets are usually tied up in their business. Prized assets, such as real estate or collections, can cause problems in estate planning because the items are difficult to split up and often have different sentimental value to each member of the family. With blended families, you have the extra responsibility of ensuring any children or stepchildren are not disinherited or treated unfairly if their biological parent passes away before their step-parent. In each of these situations, life insurance is a great solution to ensure financial equality, tax efficiency, and family harmony. Let's take a look at an example. Meet Mark. Mark stands to inherit a quarter ownership in his father's most prized asset, the family home. Sounds good, right? Well, the family home is located in a remote area 5 states away from Mark, and he doesn't plan to visit or utilize the home very much, if ever. Mark understands the sentimental value of the home, but his step-siblings from his father's second marriage happen to live much closer and will get far more value out of the home than he ever will. He asked his advisor if there was a way he could get his inheritance in cash and give the rest to his step-siblings, or if there was a way to have money set aside for maintenance and property taxes, because Mark didn't think it was fair to pay a quarter of the cost on a property he never used. If Mark's father wanted to help his son and stepchildren with his home's upkeep and taxes, he could establish a real estate trust. Funding the trust would require an infusion of cash through annual gifts. He then could leverage these annual contributions by funding the trust with life insurance. The proceeds from the life insurance would ultimately be used for the property, and Mark and his siblings wouldn't be burdened by their inheritance. Having that money in a trust ensures the funds aren't used for anything else. However, Mark's situation still has the potential for significant conflict. Even if there are funds set aside to maintain the property, he still feels that he's getting a property for his inheritance that he doesn't get to use. To really ensure a smooth and equitable transition, Mark's father could establish a trust for the benefit of all his children. The goal of this trust is to create a fair and equitable transfer of the estate. In addition, it could provide enough cash for any of the children who may want to buy the house from his estate. This trust needs a significant infusion of cash, which can be created with life insurance. Mark's dad can use an annual outlay that is just a fraction of the total benefit. With this lump sum of cash, the children that truly love the home have the wherewithal to buy it from their siblings. This strategy essentially acts like a buy-sell agreement. So what did we accomplish for Mark and his family? We created a tax-efficient pool of cash using discounted dollars. We gave all the children choice, control, and flexibility. And finally, we provided a seamless transition for the prized family home. So what should you be looking for? Look at your book of business and pay attention to a few key factors. Clients that have at least $1 million in transferable assets. Clients with a family business with one or more children involved. Clients with prized assets. Clients with blended families. Look for clients who have remarried or who have step families to consider. Once you've identified those clients, it's time to take action. Ask for an appointment. Start having real conversations about creating an effective and fair wealth transfer plan that meets their wishes. Any questions? Of course, you can reach out to your team at Ash Brokerage. We have plenty of answers around this concept and other advanced planning strategies.